Most crypto losses aren't from missing a chart, they're from decisions made under pressure. When the market gets loud, your brain starts negotiating with you. Just this once, just this entry, just this leverage, let me buy this meme, and then you're disciplined again. But here's the snapback. You don't fix this with better coins or more altcoins, you fix it with a better process. And in this video, 3 biases that wreck decisions, and a simple routine to stop self-sabotage. A decision journal plus 3 data checkpoints: regime, risk, and behavior. So this is the moment right before you click buy or right before you panic sell. Because if you can slow yourself down by 90 seconds, you stop donating liquidity to smarter players. And a quick side note, yeah, I'm a Liverpool supporter and Oz is a Man United supporter, and yeah, it is as painful as it sounds, but it's a good example. Fans don't watch the whole season, they watch one match and decide the title's already won, and that's your brain talking in crypto. So the first bias, herd mentality. Crypto just wraps it in a nicer outfit and calls it FOMO. You're scrolling and it feels like everyone is winning except you. Your brain doesn't want to be right, it wants to belong. And here's the ugly part. Social feeds amplify herd behavior. Research in behavioral finance and crypto market studies repeatedly finds herding rises when uncertainty is high. So what's that mean? When things get messy, crowds get louder, not smarter. And every cycle, the loudest moment is usually near turn. Not always the exact top, but near the point where risk is worst and confidence is at its highest. The herd tends to arrive when it looks easiest, and that's the trap. So here's the first checkpoint. Regime. Before you act, ask yourself one question. What phase is the market in right now? If the crowd is screaming alts are back, we're gonna go to the moon, but Bitcoin dominance is ripping higher, that's most likely not alt season. That's a liquidity slap waiting to happen. And if BTC is weak and total 3 is rolling over, the herd is chasing noise. Regime first, because it tells you whether the crowd is early or just exit liquidity with a microphone or tapping away on a keyboard. The second bias, confirmation bias. This one's quieter, but much more dangerous. You don't look for the truth, you look for permission. You scroll until you find a one post that agrees with you and then you stop. And you see it every cycle on Crypto X. Someone's deep in a bag, funding is overheating, the chart is stretched, and the only thing they post is narrative and hopium screenshots. Yeah, narrative can be useful, but it's not a risk model. And the second checkpoint, risk. Not your feelings, not your conviction, the market's risk temperature. If sentiment is euphoric and funding is stretched, you don't need another bullish thread. You need to ask yourself why the market is paying people to stay long and what happens when the crowd gets forced out. And this isn't about being bearish, it's about not letting confirmation bias turn confidence into a slow motion mistake. The third bias, loss aversion, a classic behavioral finance point. Losses hit harder than gains. That's why people do dumb things to avoid locking it in. And you recognize it instantly. You find things when people say, yeah, I'm not wrong, I'm just early, I'll sell when it's back, and suddenly you're emotionally married to the bag. And this creates a brutal pattern. People sell winners too early to secure profit and hold losers too long hoping for a miracle. That's not investing, that's therapy with candles. Third checkpoint, behavior. Not the behavior of your chart, but your behavior. This is exactly why a decision journal works. Not because it's fancy, it's because it removes the in the moment excuse and the need to be impulsive. Write the reason, write the data, write what would change your view. Most people never journal trades for one reason. It exposes patterns and it exposes things that are uncomfortable. So here's the routine. Before you buy, before you sell, before you add a little bit more, slow it down a second. First, regime. Zoom out and ask yourself, where are we in the cycle right now? Second, risk. What's the market temperature? Is it calm or is it overheated? And third, behavior. What's driving this move? Is it a process or is it a pattern repeating? And that's the whole point. Not to switch your emotions off, just to stop your brain bargaining with you in the loudest moment. Now zoom out for a second. This isn't about being perfect. It's about being consistent when the feed is trying to drag you down. So if you run regime, risk and behavior first, you make cleaner decisions and you stop handing the market easy wins. And quick one before you go. Which one gets you the most? Is it FOMO? Is it confirmation? Or lost aversion? Drop one word in the comments and see you in the next one.